Hello and welcome to Let's Talk Tax, the show for growth-minded CPAs and real estate pros in tax. I'm Tim LeMasters. In today's episode, we are talking property tax appeals, specifically how commercial vacancies are impacting valuations, and what that means as more companies return to the office. The market is shifting. Vacancy rates were high during the peak of remote work, but now we're seeing a transition. The question is, are property tax assessments keeping up? We'll dig into how vacancy can be a strong argument in an appeal, but also when it's no longer enough as spaces begin to refill. Understanding how assessors are viewing occupancy trends and what documentation supports a successful appeal is critical in this new landscape. Joining us today on Let's Talk Tax is shareholder Justin Gephart and property tax consultant Tanner Cox. Welcome, guys. How we doing?
Doing pretty well.
Great, man. You did a great job there.
Thanks. I appreciate it. How's it feel to sit on the other side of the table?
You know, it's a little nerving.
I bet.
Don't know what to do with my hands right now.
Yeah, I was feeling the same way. I'm sorry about that. So, well, guys, I appreciate you taking some time today. I know this is an interesting topic just because obviously, Tanner, we were talking the other day a little bit about this, and you always think vacancies create opportunity for property tax appeals, but something you had talked about a little bit is we're seeing that it's still opportunity. Maybe just do a quick introduction yourself and then walk us into that a little bit.
Yeah, so my name's Tanner Cox. I'm a member of our property tax team, currently working out of the Dallas office. So one of the interesting things about specifically with COVID, if we're allowed to say that word, is we saw a lot of people start working from home, and the American office real estate industry really thrived off of people being required to work in office. And then with COVID and many people starting to work from home, and then there being a big push for a minimum hybrid work, there was a lot of companies that started to choose to allow either the teams to be fully remote, or they just didn't need as much office space because of different employment situations, efficiencies, and whatnot.
Well, it's a lot in our industry, I'll tell you that.
Oh, yeah.
I mean, our industry itself has been hugely impacted by the work from home. I mean, we have some relationships now, Justin, you know about this. We have some that don't even have offices. Mm-hmm. So as we look at that, I know when we talked, you said, hey, people are coming back, but there's still an opportunity. So dig into that a little bit.
Yeah. So one of the things we're seeing is that a lot of cities that previously were kind of a major work hub for office workers, that's starting to change as a lot more people are moving to Texas and Florida and out of places like California and New York, which used to have a much stronger office population. As a result of that, the vacancies go up quite a lot, which in turn means that properties are not selling for as much as they may have just a few short years ago, because one of the big drivers of what the value of a office building is how many clients you have in there, how many suites are filled. Mm-hmm. And that's, as people have moved out of New York and decide, hey, it's not as economically viable as an office space, those vacancies are going down, so those values need to be adjusted downwards. We hold the assessors accountable in that. And also, a lot of them are moving to Texas, which means a lot more investment in places like Dallas and Austin. And as a result of that, there's a lot of assessors that may get particularly aggressive about moving those values up quicker than they should, overestimating the level of volume that may be coming to their county.
And we've seen this in the environment where some office buildings 4 or 5 years ago were selling for, 60, 70, 80 million dollars. And we've seen some of those sales recently where they're only selling for 15, 20 million. They're a fraction of what they're being acquired for. So that has an impact on how the potential ability to appeal a property, because what we find is a lot of time that the local assessors, they chase sales. Mm-hmm. So they see a value that happened years ago, and they tie the assessment to that value.
And that's something I want to talk about a little bit. How are these assessors, obviously if you look at, single buildings, smaller buildings, not high rises where there's multiple tenants in it. You got a single tenant in a single building. Those seem to be a little bit easier to assess. Obviously they still make mistakes just based on how they do the groupings. But talk about these high rises. How are these assessors looking at these?
Unless it's in the first year, cost doesn't really matter when you're talking in terms of an office building, because if they were to build it and then turn around and sell it, the only thing that's going to matter to a buyer is how much revenue are you going to be able to generate from that, and whether it's going to meet your metrics in terms of profitability. So it doesn't matter whether it's made of gold. That's the only thing that they're looking at.
Okay.
Well, and typically and step in here real quick, you're really looking at three main arguments when you appeal a property.
Yeah.
Okay. You're looking at cost approach, market approach, and income approach.
Mm-hmm.
What we typically see on the commercial side is that income approach that we rely heavy on. So we take a look at how are they being assessed, and then we come up and we look at the actual income, and we extrapolate that into a valuation. So that's, I think, what you were getting ready to get into is just
Right.
that income side is very important with these commercial properties.
Yeah, it's very important. One of the aspects of that is the vacancy rate, and what we've seen with some of our clients is having a situation where the assessor, when they're determining, they kind of determine a vacancy rate for the market, broadly speaking, because they don't have access to the information for each individual property.
Okay.
And so the market vacancy rate may not be reflective of the vacancy rate of that building. And there may be a very important reason for that, in which case we have an opportunity to appeal. You also can have situations where it's a brand new building and it's in lease up. So we have a client that we're working with right now in Utah that they just built an office building, and they're having some difficulty. They built it 2 years ago, and they're having some difficulty placing the appropriate number of tenants. So the assessor came in and valued it, presuming the market vacancy there is about 8%. However, our client's case, due to a couple of different factors, their vacancy rate is closer to 50%.
Okay.
And the assessor isn't taking that into account because they don't know. So that creates a great opportunity for us to come in and say, hey, you need to back off the value on this, and then through the process of negotiation, whatnot, demonstrate why there's factors that make this property unique and why it needs a different approach.
Very nice. Yeah, I think it's good insight. Something that I think we should talk about just a little bit. We don't have to spend a bunch of time on it. You mentioned the three approaches that we look at. Can you just clarify, you went through them pretty quickly, but just clarify kind of what each one of those mean and why we take that approach?
So, as Justin said, there's three valuations. In property tax, we're really only asking one question. If you were to put a property on the market tomorrow, what would a buyer with all the relevant information available to them, what would be the informed purchase price that they would be willing to expend on that property? That's it. The three approaches are just different ways to come to that determination based off of the type of property that it is. So the income approach, you're looking at the revenue generated from rent minus the fixed expenses, and then divide by a cap rate. That's what any buyer is going to use to determine the desirability of the building.
Well, think about, and just to extrapolate on that, think about the building we're sitting in right now.
Mm-hmm.
Okay. Just had a major sale go through at a fraction of the cost. Well, why is that? Think of all the vacancy. The law firm that had 4 floors is out.
Accounting
CPA firm, the accounting firm is out. And so that's going to affect a buyer's desire to pay top dollar.
Yeah, because basically they're thinking I've got to come in and I've got to kind of reconstruct some things.
Yep.
Maybe put a restaurant in, maybe put remodel it to be from or hoteling or whatever it is. So it definitely makes sense. And jumping over to the cost approach, I think the cost approach is pretty interesting because from what I understand, the cost approach, we're taking that building and we're looking at it as if it was newly built. What would that cost in its current state? And that's really how you kind of evaluate what makes sense on an actual appraisal and how they should be looking at it from an assessor side.
Exactly.
Is that correct? Exactly.
You got it spot on.
Okay.
Look at that.
Look at me. Yeah. You
One
guys
of
be
the
interviewing
things-
me today?
You are such a nerd.
I'm telling you what, man. Love this stuff.
One of the things Justin mentioned, which is something that we've been seeing more of, is the sale chasing, though, when it comes to the cost approach. So we've had a couple of clients that had some car washes. And with car washes, those are usually purchased as is. And the big thing about car washes is that they've already got an established client base. So when somebody goes to sell that, you're not really selling just the structure. You're selling the client base. You're selling the
goodwill.
staff. Yeah,
Mm-hmm.
the goodwill. The staff is usually coming with it and whatnot. So the price is much higher than it would be if you were just selling a structure.
Yeah.
And so what some assessors will do is something called sale chasing, where they'll just say, oh, you paid $5 million for this car wash. That's what it's worth. And then we have to come in and go, no, there's the goodwill and all that other stuff that I just outlined. That's included in the purchase price too. And so we go through and do a cost approach of, hey, if we were to recreate that car wash on the lot next door, what would it cost? That's what the valuation should be, not whatever somebody purchased it for.
Yeah. And the last one is market approach.
Yeah.
Explain the market approach, which I do know this one too, but I'm not gonna get too nerdy with you guys today. So
that's the one that's usually used for valuing houses. That's where you see it the most. It's just, hey, finding other properties that are relatively similar in square footage and design, and making the small adjustments that are needed and saying, hey, these are what other houses or other structures are going for in the area. And arguing based off of that.
So basically what they're doing is they're looking at a home, maybe 3 or 4 homes that just recently sold. Say they sold for, much more than what the houses were originally. And, those homes may be 20, 30 years old, but they're fully renovated, fully updated. So they have, brand new appliances, the kitchen's fully updated, bathrooms are fully updated, brand new paint, everything looks pristine. So they're taking those homes, raising the value of the rest of the homes, because it's kind of like a lick the thumb, put it in the air and say, well, this one sold for that one sold for that, so we're going to raise all of them. But the reality is these other homes probably won't sell for that if they were to go on market, because maybe they're not fully updated. Am I kind of spot on there?
Spot on. And that's the general theme from an assessment standpoint, is they don't have all the data a lot of times.
Sure.
These valuations are going out in mass. The calculations are in mass, and that's where the opportunity gets created. And deservedly so. I mean, these assessors have thousands upon thousands of properties to value every year.
Well, and it's funny. I mean, when's the last time I think you've sold a home, in the last 5-6 years? I've done the same. I don't know about you, Tanner, but when you sell that house and they're like, well, we got to get an appraisal on it. Half the time they don't even walk in the house.
Yeah.
They just drive by and like, yeah, that's what it's worth. It's like, okay, I don't know if that's right, but I'll take it, because usually you give them a number and they tell you, yeah, you're right. So I appreciate you guys digging into the different approaches that we take, but something that I think we need to touch on a little bit is cap rates. Can you walk that through for the audience a little bit?
Yeah. So one of the things we've seen is that while revenues have stayed relatively flat, they've gone up a little bit. Expenses have gone up a lot, and cap rates are one that we're seeing a lot. So essentially, once again, that's another aspect that a lot of real estate buyers are looking at when they're deciding on an area. If it's a market where the cap rates are going up, that's usually an opportunity to buy property more on the cheap. And there are assessors that will mess with the cap rates in order to justify keeping the valuation higher, keep that tax revenue coming in. And so it creates a good opportunity for us to come in and make sure to keep them accountable.
Okay. Well, I appreciate that, Tanner. And it's always interesting to see the different approaches and kind of how we can look at this. Obviously, we want to make sure everybody's time involved is valued, and so to go forward with an appeal, we need to make sure that there's opportunity there. So I know your team does a very good job of focusing on that and figuring out what makes sense and what doesn't. So now getting into the actual appeal itself, everybody wants what do you need from me as a client or as a CPA? What documentation are we looking at from an appeals standpoint?
So it depends on what type of property we're working with. As we've kind of been discussing, a lot of office buildings are something that we're appealing right now. Usually that's just going to be your profit and loss statement and your rent roll, and we can pretty much take it from there. We can evaluate that and see, hey, is there an opportunity here? And sometimes the reality is, hey, the assessor is just catching up to what the market conditions are. But that's where we start with those. For cost approaches, we usually will look at the condition of the building itself. Sometimes that involves an in-person inspection of the property. If it is a newer construction, then we'll look at contractors' pay apps, general ledgers, and other documentation. If it is like a car wash, that's where we get into what we were talking about before, sale chasing, making sure that what they're purchasing it for is what the building is actually worth. And a lot of times they'll actually have a breakdown of, hey, this is the allotment of the purchase price to the building, this is to the goodwill, et cetera. And so sometimes that's all that we need. That's the golden ticket to getting a reduction, getting that value back down to where it should be.
What would you go ahead, Justin?
Well, Tim, I was just going to add, kind of circling back on the vacancy side, something I wanted to bring up is obviously vacancy creates a large opportunity, but with all the vacancies, we see developers getting a little more creative and they're converting property into different use.
Okay.
Office building going into hospitality are going into the residential side, retail centers going to office. Those are all in addition to vacancy, which vacancy will create this change, but that change can also create opportunity because, again, these assessors are looking at it through a lens of what the property was at the time. If it gets converted into something else, it may adjust one of those variables that are used to do the assessment. So kind of looking at your overall theme in the beginning from a vacancy standpoint, it really is a trigger for a lot of conversations.
Gotcha. Okay. So when we look at all this, what's the typical turnover rate from, I guess I shouldn't use turnover rate, but what's the typical opportunity hold? Is it 50%, 60%, 30%? Usually when you go into an appeal, is it early on that you're going to have an understanding if there's going to be a change, or is this something that you got to kind of go through the entire process?
You really got to go through the entire process, Tim.
Okay.
The unfortunate part, compared with other practice lines that we specialize in, it's not as black and white. I think our arguments that we look at can be black and white. We know that the assessments are out of whack, but at the end of the day, the local assessor or the review board, they're making a decision. So we can present the best case possible, but they're going to either sign off or they're going to reject it. They're having a good day and they agree with us, or they're having a bad day, the kids were terrible at home and they're just upset and they're going to ruin the world, and they reject it.
Okay.
The good piece with that is we always have next year or the next time period open for that aspect. So, I mean, when you talk about average reduction, you're typically in that 10 to 40% range, depending on the property, depending on the location.
Okay.
But again, we've had projects and clients where they're home runs that they just get shut down. We've had others that we've appealed that we didn't really think we had a lot of ground to stand upon, and they get passed with flying colors.
Wow.
So
Okay, so it's kind of a flip of a coin, really.
100%.
unfortunately, it can be.
Okay. So at looking at all this and getting the vacancies, and I want to kind of finish out with this because I know this was a big part of our conversation today. People coming back to office. Help me understand what argument you can make when that's happening.
It really depends on the area. So some companies, like I said, they're moving. They did have an office situation that worked for them pre-COVID. That's not always the case afterwards. So some of it is they're moving to a new state, different rules, different level. Some counties are more aggressive about their valuations. If you are in a state where a lot of people are moving from, so if you're still in New York, for instance, everybody else leaving, that vacancy can have an impact on you. That has an impact on your ability to get tenants in there, and making sure that the assessor is aware of that they're taking that into account correctly. That's very important to us. It's a very good opportunity. On the flip side, you have some assessors in places like Texas and Florida where they see just this massive influx of people, and they get over their skis because they don't have an upper limit.
Oh.
And so they'll say, no, we have this many come into our market. We can value it at this. And we have to step in and say, hey, slow your roll. It is going up, but you have way overinflated this aspect of it. You've assumed that the vacancies are near zero, and that's not true in this submarket or for this property for different reasons.
Okay.
Well, I think to add on to that, okay, vacancies are great for our argument, but as people are coming back into the office, typically expenses are associated with that. So that helps justify an argument from the income approach side. So yes, you can make an argument on the vacancy side, but as some of these offices and office buildings start filling up with people again, expenses go up, which means the assessors probably are not valuing it correctly from that perspective.
Okay. Right. Well, so if you guys were property owners, and I'm one of you, what would I say to you right now as it currently sits about property tax? And I know that's a winger of a question, but I want people who own properties to understand the opportunity that they have looking at an appeal for their current properties.
I think it's something that should be in your review every year. Okay. This is it's a hard expense that is affecting your business. It should be evaluated every single year.
And they're not out of pocket evaluating.
No.
Okay.
No. So you're not out of pocket typically until the assessment or the appeal is settled and it's a successful settlement. That's when any out of pocket would happen.
Okay.
But this is an expense that we've seen historically over the last 4 to 5 years. From our cost seg side, we see a lot of properties, we see a lot of assessments. The valuations are out of whack. And so why not, as an avid business owner, as a business owner that's focused on your income sheet, save some money.
Save some money. Agree.
Especially in like today's environment. Okay, you have markets that are up and down. You have business that, stock markets up and down. Well, cash is king, right? Think about a couple years ago, that was our slogan, cash is king. It's true today as it was then. So anything you can do to reduce expenses, you should be doing at this point. And property tax is one of those.
Does the natural disasters, does that impact property tax at all?
Oh, that can have a major impact on them. So what we've seen in California with the fires, Florida and the Carolinas with the flooding, that's a big one. Not to get too deep into it, but there are some situations where the building can be so damaged that it has no use. The only purpose is to knock it down. And so making sure that assessors are aware of that, making sure that they're only valuing and taxing you on the land, because that's the only sellable aspect of it, very, very important.
Okay.
That's a sticky conversation, obviously, because you have people going through
a lot,
a tragedy.
Yeah.
But it is an expense that at the end of the day could save you money down the road.
Yeah. I get it. Well, I'm sure there's some expense going into it with that situation.
Absolutely.
So. We did have one client, real quick. We did have one client that they had a fire last year, actually, and damaged the building. The building's still up. It still looks relatively okay on the outside, but structurally it's not usable. And it just hadn't been knocked down yet as of the date that the assessor was going to reevaluate it. And so, again, we talk about that mass appraisal thing. All they're looking at is there's a structure there. We're going to value it essentially the same as last year, maybe up it by 5%. I believe the market went up by 5% there.
Yeah.
That building's not worth anything. It's not safe to go in.
Sure.
And so our argument is, hey, you need to be valuing this just off of the value of the land, because no reasonable buyer is going to purchase it for the building. It has no use.
Yeah. Well, guys, we're out of time, but I really appreciate this. Is a great conversation. It's definitely a lot that I learned today. Even though, Justin, you found out I knew a lot more than you probably thought. So.
Well, this was Tanner's first appearance on the podcast, so good job.
Yes. Well done. I'm glad to be the host, not you.
Tim, you did a good job hosting. Didn't get to hear your radio voice, which was a little disappointing.
I'm working on that. I'm still working on that. So, well, guys, I really appreciate it. I'm sure we'll be on again soon, but thanks again for joining.
Thanks.
Thank you for taking time to tune in today. You can subscribe to the Let's Talk Tax podcast on YouTube and follow us on Spotify or Apple Podcast, or whatever you listen. In addition, today's show notes and links to more about the episode can be found online at mcguiresponsel.com/Let's Talk Tax Podcast. We'll see you next week. Thanks, everyone.